Today we're going to explore building financial statements. And so this is going to be somewhat of an intersection of accounting and finance, which for a lot of entrepreneurs are not the most interesting areas. We tend to start companies based on product ideas that we have or customers or markets that we want to serve. And it's the accounting and the finance that is something that many entrepreneurs least look forward to. But in my experience, it is one of the most important, if not the most important, area of is your business going to be successful, and is it going to be sustainably successful? And so you may not want to specialize in accounting, you may not want to specialize in financing, but it's important that as the entrepreneur and as the founder, you've got a working knowledge of it, that you can understand, you can manage things, whereas if you're working with others and they make a mistake, or if someone is intentionally trying to mislead you, you understand enough about the financials to recognize the problems and be able to respond to those instances appropriately. Specifically, a few areas that we want to focus on is to try and help you not to run out of money and not to run out of time. And what we mean by that is that if you manage your finances effectively, it gives you the opportunity to build and grow the venture, and maybe even to make a mistake or two and still recover from that. Alternatively, if you spent too much money or if you spent money at the wrong time or on the wrong thing, then you may find yourself in the problems that could have been otherwise avoided. So in that way, with our discussion of financial statements, we're going to integrate not only some of the method of how you do it, but also some philosophies to try and help you make your money go farther. So with those financial statements, there are a couple of elements that are the audience for that. One is certainly investors. Investors are going to want to see your financial statements. They're going to want to know, what are your revenue forecasts? What are your expenses? Are you borrowing money? Where are you spending your money? On what timeline? But it also, I would argue, is even more valuable for the entrepreneurs because it helps you forecast what monies are expected when and for what purpose. And it also is something that you, hopefully, are going to scrutinize before you launch the venture. Sometimes we do our business models. Sometimes we write our business plans. We do our financial statements. And we think that the next step is to launch the company. What might you do instead, based on your financials?
Get money.
You might get money to start the company, or the inverse would be what?
Start the company to get money.
What's the opposite of not starting?
Starting.
Okay, so you may not start once you've done your financials. You may find that the idea is interesting, and the market may be there to some extent. But oftentimes, it's not until you do the financials that you see is the opportunity a real financial opportunity or not. So in that way, it helps you understand, should I start? Should I not start? Or if I am going to start, what's the relative risk and reward that I'm looking at? Financial statements traditionally come in three forms. There's the income statement, that is your revenues and expenses, the cash flow statement, which is money in and out of the firm, and the balance sheet, which are your assets, liabilities, and equity, and we'll look at some examples of each of these. For income statements, it starts with revenue. So that's sales. So that's top-line money that you are generating for the company. It's cost of goods sold. It's expenses related to the production or the fulfillment of the products or services of the company. And when you think about it and where you start, it begins with the sales forecasting. It begins to think about what you can sell given your market, given the capabilities that you have. Based on what you think you can sell, what are the costs associated with meeting that demand? And what are the associated expenses for marketing and salaries and rents and other costs that are going to be incurred with that? Once you know those, and again, these are all things that we are forecasting. So we're not collecting, at this point, information on what we've done. We are writing down numbers, what we think we're going to generate, what we think we're going to spend. So once you get a sense of what are our revenue forecasts, what are our expense forecasts, it lets you know what that gap is going to be before you get to break even, and that gap is what you're looking to fill based on raising money or using savings or other sources of capital. So again, starts with the sales forecast where you need to reconcile how much are we going to sell at what price point. So in that sense, why is there a 0 period in units sold. Yep.
No one knows who you are yet?
No one knows who you are and what might happen in the first months of your venture. You are at a pre-production. You are doing things like starting the company. You are doing R&D. You are doing prototyping. So there might be other cost or other work that needs to be done. You might be a few months in before you sell anything. If you're a pharmaceutical company, it may take you 10 years to do your research and testing. So in that way, depending on your category and depending on the type of company that you're starting, it can be some weeks or months, or maybe even years. If you're going to build a hotel, it might take a year to select the property, to select the contractors, to build it, to open it. So recognize you're going to have a period in time where you might not be generating sales. But once they start, it's simply recognizing at what price you're going to be selling those at. And you might have a little bit more of a complicated chart than this because you might have different products and different types of products and so forth. But fundamentally, you want to recognize what we're going to sell, when, at what price point, and in what volume. And it's influenced by your marketing, your strategy, your competition, and a host of other areas. When you think, too, of what do I do with that? Well, we pull those sales into our income statement, and that's our top line numbers. So whatever you generated as far as your sales forecast are going to be your starting points here. So we go from thinking about our profit and our sales goals, and then once we know sales, we can get down into expenses. And we can forecast that out in time here. So that's income statement. Statement of cash flows is a little bit different. Much like a checking account, it manages the inflow and the outflow of cash. For our team that has the scooter concept, you may go to a university, you may go to a company, you may go to a retailer, and they may agree to buy 100 scooters this year. They may sign a contract where they're going to pay you $200,000 this year for your scooters. If you have a contract, you could legitimately say that our sales, based on our contract for this month, is $200,000. How much cash do you have? Might be zero. If all you have is a contract, if they have not given you a check, or if they're going to pay you in 12 monthly installments, how much are you going to make per month?
Probably $18.
15? Is that right?
Yeah, I said
18?
not 15. That's weird.
16,666. Yeah.
So 15 would leave us a little shy, but why might we underestimate?
You don't spend more than you have.
We might underestimate one, particularly with products, there might be some level of return. So maybe it's 16 and something that we would generate, but we also want to recognize there might be some returns, there might be some other issues involved with that. But the difference in income or sales and cash flow is that income and sales might be what the agreement is. Cash flow is just that. It's how many dollars, cash or check or bank wire, that we're going to have. And why do you want to keep track of that? Why not just say, we made a $200,000 sale, let's get to spending? Can you spend $200,000? you spend 200,000? No, you only have 15. You only have 16, so you can't spend what you don't have. But we want to reconcile that cash flow comes in a variety of ways. We might generate money from selling the product, that's operating. We might generate from other assets that we have, or we might spend in other assets. So cash not only reflects money in, it also reflects money out. We might sign a lease, an annual lease for a building. We might have $100,000 committed to that building for the year. But if we negotiated, we're only paying a few $1,000s in rent the first few months, and then we're paying bigger rents in the later months. It's that individual payment on the monthly basis that's the cash flow that we're managing. We might also have borrowed money and we're paying interest on that for bank loans. All of that you would capture within your cash flow statement. Looks something like this, where based on your income statement, you are coming forward perhaps at a loss. You may also have bought vehicles or equipment. To offset those expenses, you need loans. You need money from the founders. So it's money out, money in, and we have a balance. We essentially started with the $240,000, and we've incurred some expenses. What happens when your cash balance goes to zero? What do we call that?
Bankruptcy.
Bankruptcy. Can it go negative? Can you have negative cash? Can't. Cash is an absolute value. You may owe people money, but cash is like apples. You can't have negative apples. Once your cash balance is zero, you are broke, arguably bankrupt. So you want to reconcile and think about, based on the income forecasts that we have, and those will be pulled forward here, and based on the expenses that are already embedded within that from your income statement, how much money do we need, with what frequency, and how often to keep that cash balance above zero? And this is at least a starting point for that. And that you think about, what startup expenses do I have? Do I have one-time expenses that I'm going to be incurring? Do I have monthly expenses that I'm going to be incurring? Salaries and equipment or inventory or other things. Hopefully I'm going to generate some revenues in time that will help me cover some of those expenses. And I might be positive in the end, or I might be negative in the end. And it's based on kind of the sum of those values of how much money you need to raise to either start your venture, and you might need to raise subsequent monies later in your venture. The third and final element of the financial statements are the balance sheet. And with the balance sheet, you're looking at assets, and assets are things that are cash, inventory, monies that are owed to you. You might have other fixed assets, property, equipment, things of that nature. The other side of that are liabilities. People may owe you, but you may owe people. You might have loans. You also may have equity or ownership in the form of stock that is owned by the founders or owned by investors. The central theme here is these things have to equal. Whatever assets you have need to cover whatever liabilities there are. Essentially, whatever you have that's a positive needs to be able to cover whatever it is that you owe. And then if anything's left over, that's equity in the company. And so those are terms that balance out. And what we see with that as an example of a balance sheet is this, where we have some cash, we have some equipment that might be depreciating, we have some loans and other payments that we need to make, and what's left over is essentially equity or ownership in the company. in summary, when we think about financial statements, it's a tool for investors, it's a tool for lenders to evaluate the potential of your firm, but it's an equally, if not greater, tool for the entrepreneurs themselves. These are key to understanding your venture and key to understanding the potential of success and what needs to happen from a financial perspective for your venture to be a reality. What the financial statements can also do is help you recognize how much money you need, when, and for what purpose, and how to manage that effectively. The financial statements also help you quantify the risk and reward. And in that way, it should help answer the question, do I launch the venture or not? And so in that way, when you have an idea, you look at markets, competitors, the industry, things may begin to line up. You have a price point in mind, customers have validated that price point. It's only when you go to the financial statements that you can see, does the math work? Does the business model work? Does the relationship of my cost and my expenses as related to my revenue and my profit goals make sense for something that I would like to pursue and make sense for something that I can build a venture on?